Despite my age, at 71 years of age, I'm trying to become richer. And trying to become richer involves buying high quality assets at fairly inexpensive prices. So while you're discouraged by the gold trade, I'm elated by the gold trade. I would like to buy more gold stocks, in particular high quality gold stocks. And the fact that they're selling at prices which I consider to be attractive is wonderful for me. I realize that I'm different than a lot of people. I want to differentiate too between investing in gold itself and investing in the gold stocks. I own gold as insurance. I own it because I'm afraid. I began adding substantially to my physical gold holdings in 1998, admittedly a couple of years early. But I noticed that since 2000, the gold price has gone from $256 an ounce to something like $2,000 an ounce. An 8 or 8.2% compound annualized rate of return. Gold did exactly what I asked it to. Exactly what I asked it to. And it did it in a circumstance where, first of all, the denominator, the US dollar, also did well against every other currency in the world, which is to say, if you were saving in any currency other than the US dollar, including the Canadian dollar, you did better in gold than I did. But it also did well in a circumstance where people weren't concerned. People weren't fearful. What really moves the gold price is a lack of faith in savings instruments denominated in fiat currencies, in particular in the US dollar. And my suspicion is that as the really truly pernicious impact of inflation, true inflation, not the CPI, begins to bite people, that their fear of inflation and their receptiveness to inflation-oriented investment techniques, including gold, will increase.
Renowned investor Rick Rule provides compelling insight into why he believes gold prices are poised to increase. Backed by data, Rule highlights the historical performance of gold, noting its impressive 8.2% compound annualized return since 2000 amidst a strong US dollar. He emphasizes the critical role of investor sentiment, predicting a potential surge in demand for gold as fears of true inflation grow. Additionally, Rule discusses the undervaluation of gold stocks relative to the gold price, attributing it to past industry challenges and managerial changes. With institutional investors now exerting tighter control, Rule remains optimistic about the future prospects of gold. Don't miss out on valuable insights like these. Remember to like, share, and subscribe, and turn on post notifications for more updates.
I mentioned that the market share of precious metals and precious metals-related securities in the U.S. market, I can't comment on the Canadian market, but in the U.S. market was less than 0.5%, which is to say that the market share of gold and silver, precious metals-related assets relative to every other asset class is less than 0.5%. The 4-decade mean market share was 2%. If the fear of inflation, among other things, begins to catch people's notice, my suspicion is that the market share of precious metals will revert to mean. It'll go from 0.5% to 2%. That would generate a 4-fold increase in demand for precious metals and precious metal securities. And that's precisely what I think is going to occur. Will it occur tomorrow? Likely not. I don't expect a U.S. interest rate cut in the near term. And I don't expect an immediate diminishment in confidence in the U.S. market, which means that 2024 might be fairly benign. And hence demand for gold could be constrained. That doesn't really matter to me. I've come to learn that my life seems to be denominated in 5 to 10 year cycles, not 5 to 10 week cycles. Now, the gold stocks are different than gold. The gold stocks are trading as cheaply relative to the gold price as they have ever been in my career. Partly, I think that's a function of the fact that speculators don't own gold for the reasons I do. They don't care about 8% compound returns. They want some number like they experienced in the 1970s. And they think that the fact that they want something is somehow relevant, which it isn't. But I think, too, that the structure of the gold stock market, which is to say the performance of the gold mining companies as companies, has left a lot to be desired. In the period 2000 to 2010, the gold price, as you recall, ran from something like $250 to something like $1,750. And the free cash flow among an index of senior gold and silver producers declined. It took amazing skill to take a sevenfold increase in the selling price of their product and turn it into a decline in free cash flow. The consequence of that is that gold investors in general, and particularly generalist investors, looked at the gold mining sector as a place where capital goes to die. The event that you would want, a rapid increase in the gold price, delivered a decrease in the per share cash flow. Now, I would like to point out to investors that the institutional investors are keeping the gold mining companies on a much tighter leash now. And most of the management teams that presided over that diminishment in value have been allowed to pursue other employment activities. They're doing something else.
Continuing his analysis, Rick Rule delves into the nuances of investing in junior mining companies, cautioning viewers against treating the sector as a whole. With over 2,500 companies in the global universe of junior miners, Rule emphasizes the need for discerning stock selection, pointing out that while most companies in this sector struggle financially, a small percentage yield exceptional returns. He stresses the importance of viewing gold mining companies as individual entities rather than mere proxies for gold itself. Rule then provides a real-world example involving Franco-Nevada and the impact of a specific mining project on its stock price, highlighting the potential opportunities for astute investors amidst market fluctuations.
Coming down from there, all the way down to the junior companies, we've talked about this before. If you invest in that sector as a sector, you will go broke. The 2,500 or so companies that populate the global universe of junior mining companies, were you to merge them all together, call them Junior Explorco or something like that, that company in a very good year would lose $2 billion. In a bad year, it would lose $8 billion. So the sector as a whole is where capital goes to die. That obscures the fact that maybe 5% of those issuers generate such superb returns that they add legitimacy and sometimes luster to a business that loses between $2 and $8 billion a year. This is all about stock picking. This is all about disciplining yourself as an investor. This is all about regarding gold mining companies as companies, not merely as proxies for gold. And I think that we're in a uniquely good period to do that because there's no competition among other investors. Let's look at a little arithmetic just for fun to illustrate this. Franco-Nevada, from my point of view, the preeminent gold mining equity on the planet. Lowest management expense ratio, highest operating margin, loses Cobre Panama, at least temporarily, which accounted for 15% of net asset value. And the stock declines by 42%. Now, let's make this dollars and cents. You start with a dollar bill. Somebody takes away a dime and a nickel. Somebody takes away 15 cents. And the consequence of that is that the company now sells for 68 cents. What kind of arithmetic is this? In particular, because if you look at the Cobre Panama situation, you come to understand that there's $8 billion invested in that mine, that the mine constituted 25 or 26% of Panama's export earnings and 7 or 8% of GDP. And if they actually have to go through international arbitration, there will almost certainly be a judgment against the Republic of Panama in favor of First Quantum and Franco-Nevada. But more likely, over 2 or 3 years, there will be a political resolution to the dispute. But even if there's not a political resolution, you have a circumstance where sentiment caused a market where 15% of net asset value came off to decline by 42%. This is a wonderful circumstance. If you are an investor that doesn't require the psychological support of a market, if you understand that a market isn't a source of information, but is rather a facility for buying and selling fractional ownership in businesses. The idea that these better businesses get sold off continually is, if you are a true investor, a huge benefit to you.
As we wrap up today's discussion with Rick Rule, let's recap the key takeaways. Firstly, Rule emphasizes the importance of investing in high-quality assets at attractive prices, particularly in gold stocks. He highlights gold's historical performance and predicts a potential surge in demand fueled by fears of true inflation. Furthermore, Rule distinguishes between gold and gold stocks, urging investors to view gold mining companies as individual entities. He provides insights into navigating the complexities of the junior mining sector, stressing the significance of disciplined stock picking. Lastly, Rule shares a real-world example illustrating the opportunities for astute investors amidst market fluctuations. We hope you found today's insights valuable. Don't forget to subscribe to our channel, like this video, and share your thoughts in the comments below. Thank you for watching, and we'll see you in the next video.